2025 has been a pivotal year for federal tax policy, driven primarily by the enactment of the landmark One Big Beautiful Bill Act and extensions to key provisions from the 2017 Tax Cuts and Jobs Act. Given all of these changes, now is a great time to leverage strategic year-end tax planning to capitalize on new opportunities and safeguard against emerging risks. Here to walk us through how to do just that are William Vaughan Company senior tax managers, Chad Gates and Ruben Becerra. With over 22 years of collective experience at our firm, these two are highly knowledgeable in the nuances of tax code and have frequently guided their clients through complex regulatory changes, legislative updates, and strategic tax planning scenarios. So all of that said, I will turn it over to Chad and Ruben.
Thanks, Lindsay. Like Lindsay said, my name is Chad Gates. I'm a senior tax manager here at William Vaughan Company. I've been with the firm for about 10 years. This is my second go around doing these presentations.
And I'm Ruben Becerra, so I'm a senior manager at the tax department as well. I've been with the firm going on 13 years now. I'm pretty well versed in these presentations. So.
Well, we're going to start the day off with a CPE polling question. Lindsay, if you could please get that one up.
Yeah, so as I said, if you require CPE, please complete the poll questions. We'll give everyone a couple seconds to complete this one. Back to you.
Cool, thank you. So Ruben and I did one of these presentations back earlier in January. At that time, we knew the results of the 2024 elections. Obviously, President Trump won the election. Republicans also won the House and the Senate, albeit very slim majorities. But back in January, all we could do is speculate what any tax legislation may or may not include, as we knew we were running up against the expiration date of the Tax Cut and Jobs Act. All that tax law basically was going to expire at the end of 2025. So we knew at that time everything was either going to revert back to pre-TCJA rules, which were fairly taxpayer unfriendly, or they were going to come back and extend the provisions or come up with something completely different. That's where we came into the Public Law 119-21, the One Big Beautiful Bill Act, OBBBA, OB3, OBA, whatever your acronym of choice is there. The TCJA was passed with something called budget reconciliation, which just meant the Senate didn't have a supermajority, which would be needed to bring anything to an actual vote. With the Senate majority being 53 versus 47, Republican versus Democrats, any tax law changes to remedy the expiration of the TCJA would likely need reconciliation as well, which is what they did. It was also a very eventful summer with what was going to be included in the House version of the bill versus what was included in the Senate version of the bill, and then reconciling those two together, and then one passed another one, and then eventually it all came together on July 4th when President Trump signed the One Big Beautiful Bill Act into law. The first main item that we're going to talk about that changed with the OBBA is bonus depreciation. As we know, bonus depreciation came into play several years ago. The first few rounds was you were able to expense half of the asset cost in the year of acquisition. TCJA came around at the very end of 2017, bringing in 100% bonus depreciation, where you can expense the entire cost of an asset the year that it was acquired. Those rules have changed quite a bit, and the main taxpayer unfriendly provisions of bonus depreciation were it started to phase out. Beginning in 2023, it would phase out in 20% increments. So 2022, you could expense 100% cost of the asset. 2023, you could only take 80% of that cost as bonus depreciation. 2024, it went down another 20% to 60%. This last year, 2025, it was only at 40% eligible for bonus depreciation. And then the OBBA came into play, and basically any asset acquired after January 19th, 2025, so long that it has an asset class life of 20 years or less, we're able to go back to 100% bonus depreciation. And one of the cool things with the OB3 is this is a permanent tax law change. It doesn't phase out after 5 years. There's no sunset provision at the end of 10 years like we had with TCJA. Bonus depreciation is here, and it's here to stay. That is until we get another piece of tax legislation that changes everything. But one of the new provisions, so we're all fairly familiar with bonus depreciation on these 20-year class lives or less. We've been playing in that field for over a decade now. But the OB3 brought in one new asset classification called qualified production property. QPP is essentially commercial real estate that is used as an essential part of an activity, including the manufacturing, production, or refining of certain tangible property that significantly transforms the product. Basically, this is your manufacturer's accelerated depreciation on real estate. There's very, very specific requirements, what that real estate can be used for, and it basically lists everything that it can't be used for. An example is a portion of a parking lot, admin services of a business, lodging area, basically anything that's not literally the manufacturing part of your factory. It also has a very specific provision where the construction has to begin between January 20th, 2025, inauguration day, and between January 1st, 2029. And then that real estate needs to be placed in service by the manufacturer on U.S. soil or a territory owned by the United States by December 31st, 2030. The main caveat with this, which tripped a lot of people up writing early articles once the OB3 was passed, was the actual manufacturer company needs to own this real estate. It can't be leased property. It can't be owned by a real estate holding company that leases the property to the manufacturer. The manufacturer entity itself needs to be the owner of this qualified real estate property for it to be eligible for 100% bonus depreciation. And while we're talking about bonus depreciation and depreciation in general, we're going to talk about 179 limits. The OB3 basically doubles the 179 limits. It was around $1 million. Now it's $2.5 million. The phase out also increased from roughly $2 million to $4 million. And all of these changes are subject to inflationary adjustments annually. And they are the new higher limits are in effect for tax year 2025. Next up on the list of things that change with OB3 is this interest expense limitation under Section 163J. This was part of the Tax Cut and Jobs Act of 2017 as a revenue raiser. Basically, what it does is it limits the amount of business interest expense you're able to deduct on a tax return to 30% of adjusted taxable income. The first several years of this new limitation, you were able to add back certain expenses to get to that adjusted taxable income. Some of those items were depreciation, amortization, and depletion, thus giving you a higher taxable income base to take that 30% limitation against. Beginning in 2022, that you were no longer able to add back that depreciation, amortization, and depletion, lowering that adjusted taxable income and subjecting more of this interest expense to be disallowed. That disallowed interest is carried forward into a future year. It was treated just like any other business interest expense, subject to the same limitations. This was, since it was part of the TCJA, it was slated to expire at the end of 2025. OB3 came into play, extended it permanently, but it had one major taxpayer-friendly provision where beginning in tax year 2025, you are able to add back that depreciation, amortization, and depletion again, increasing that taxable income base, allowing more business interest expense to be deducted. However, there was one not so taxpayer friendly provision, and it has to do with this concept of capitalized interest. Typically, when you're capitalizing interest, it's usually on a long-term construction real estate project, and every time you have an interest expense, you just add it to the cost of the asset, which will eventually be depreciated. OB3 came in and said, we don't really care if that interest expense is treated as interest expense or capitalized as part of that asset. Starting in 2026, we're going to treat it the same, which means you're basically going to have to, for this capitalized interest, break that percentage of that year's depreciation out, and that little tiny piece of depreciation, which is truly capitalized interest, is now subject to the 163J limitations. That was a really nice tax planning opportunity we've had in effect the last several years that's no longer available to us.
All right, so Section 174, research and experimental expenditures, for those businesses that were whether heavy in R&D or just kind of had any kind of R&D activity over the last several years, this is probably one of the most anticipated changes to come from this one big beautiful bill over the summer. So if I take a step back a little bit for anyone that just doesn't know, or just to kind of give some background on it, right? So prior TCJA, Section 174 was really a non-starter. No one really cared about it. Even prior to 2022, really, no one really cared about it, right? We had these Section 174 expenses that were there. We could always immediately deduct them, so we didn't really care what they were or the specifics of them, so to speak. TCJA came in and added this provision that starting in 2022, companies were going to have to start capitalizing these Section 174 expenses and amortizing them over the next 5 years. There was a lot of talk over the last several years, right, even leading up to 2022, that wouldn't end up coming into place, or over the last several years after it did end up coming into place. I think we've been talking every year on these tax update presentations about, hey, maybe there's a fix coming, maybe there's something coming through, maybe there's some optimism about that getting fixed, and nothing ended up happening those last few years. So finally, with this bill, we get a fix, quote unquote fix for this going forward. So starting in 2025, we are now able to immediately deduct our Section 174 research and experimental expenditures again. So that's obviously a huge benefit for a lot of our clients, huge benefit for a lot of you that are heavy in R&D. We've had clients that were adding back $1, $2 million, $3+ million of R&D expenses these last few years. Companies that were, would typically be making hundreds of thousands of dollars in taxable income, all of a sudden are making millions of dollars in taxable income, and needing to figure things out and how to pay for those. So definitely a huge benefit for companies going forward, starting in 2025. Unfortunately, it doesn't quite kind of get simple from that standpoint, right? Because all of these companies have been adding back these expenses these last few years. So at the end of 2024, all these companies that have been doing that now have capitalized expenses sitting on the books. So this bill also had to kind of address, okay, what do we do with those going forward? And so this bill kind of gives you 3 different options depending on where your gross receipts are at over the last several years. So if your gross receipts are under that $31 million threshold there over the last few years, kind of average, you have the option to go back and amend your 22 through 2024 tax returns and essentially file those assuming that you could immediately expense your R&D expenses and kind of get a refund immediately and go from there. One caveat there that you want to keep in mind right now is that's really just for federal purposes. We are still waiting for states to kind of figure out what they're going to do with it. So those amended returns are only for federal. If you are above those $31 million in gross receipts, you have a couple of different options. So you can either choose to expense that dollar amount that you have still capitalized at the end of 2024. You can expense all of that in 2025, or you can elect to expense half in 2025 and the remaining half in 2026. So say you have $1 million left sitting on the books at the end of 2024, you can choose to take that $1 million deduction right away in 2025, or you can take $500,000 in 2025, $500,000 in 2026. So some flexibility there from a tax planning standpoint to kind of figure out, okay, what do we want to do with that, right? So for a lot of our businesses that are in this spot, you're looking at likely down taxable income years, right? Whether that's at the business level or it's pass-through entity that's going to pass through to you. And maybe you're already down for whatever other reason, right? So maybe we want to look at that from a tax planning perspective to figure out and say, what do we want to do with those expenses for 25 and or 2026? A couple other things on the amended piece is that amended isn't necessarily a like automatic answer yes. You'll want to kind of take, if you fall into that category, you'll want to take a couple different things in account when trying to decide if you want to amend. First off, if you've had any kind of like changes in ownership, right? Maybe there was a death and there was something that happened there, or sale of interest, things like that. You may not want to amend to kind of open up some of those years and some of those issues that might come with that. Or if you had, say, if you were an S corp and you took deductions took distributions based on your taxable income in those years, and now you go back and amend, and all of a sudden you don't have the taxable income, and maybe you have distributions in excess of basis, things like that, that you'll just definitely want to kind of, it's not a blanket, yep, I can under $31 million, I'm going to go back and amend and get my refunds. You're potentially opening yourself up to some pitfalls there. So you'll just want to make sure that we kind of thoroughly go through those scenarios and make sure we have a good understanding of that thing, of everything on that front. Next, so Michigan decoupling, it's relatively new. So we want to kind of touch on it, obviously, because Ohio-based, we have a lot of companies that have a lot of activity in Nexus in Michigan. So back in October, Michigan signed a budget package that essentially decoupled from all the major business provisions, beneficial business provisions from the One Big Beautiful Bill Act. So they kind of listed out there, right? But essentially for Michigan income tax purposes, your R&E expenses, you're not able to immediately deduct those. You're still following the same rules where you need to capitalize them and amortize them over the next 5 years. The business interest deduction is not going to allow depreciation and amortization getting added back to your taxable income to come to that limit. Your Section 179, those are the previous limits, so they're not, so Chad just talked about, right, the increased limits on those. That is previous limits for Michigan purposes. The bonus depreciation that Chad just talked about on your qualified production property, Michigan's not going to allow that. And then bonus depreciation in general on your corporate taxpayers. Again, we just talked about how that's up to 100% now. Michigan is going to continue to disallow that entirely for the corporate taxpayers. And then for the individuals and FTE taxpayers, bonus depreciation will still be allowed, but it's going to be allowed at the normal phase out ranges, right? So over the last several years, we've had phase outs of went down from 100% down to like 60% is where it ended up getting to. Michigan's going to continue that forward until it ultimately gets to 0% and not allow the full 100%. And really, so this is just Michigan specific, like I said, but the real big takeaway I think from this is that all of your states are going to handle this differently, right? Whenever we have a big kind of tax law change like this, all the states kind of look at their budgets, look and see, okay, where can we actually take some of these things, or where do we actually need the revenue? Where are we going to decouple from this? So as you're kind of going through year end, as you go into tax prep for next year, you'll just want to make sure that you double check, are the states following these rules? What states are, what states aren't, and make sure we kind of have a good calculation just so you're not hit with a big tax bill from a state down the road that could have been prevented. Next up, our qualified business income deduction. So this has been also in place since the TCJA came out. This high level, again, is essentially a 20% reduction on your qualified business income. Um, for the mechanics standpoint, essentially all stay the same. This bill didn't change anything from a mechanics standpoint. The 20% deduction is still there. The big thing that it did do, though, is it did make it permanent. So this was one that was set to sunset after 2025. This bill came in, and 2026 forward is permanent now, which is really good for us, especially from a tax planning perspective, just because it gives us some consistency. I think that's a theme that we'll talk about quite a bit from a planning perspective going forward. Is it's just okay, now we have some known things to keep in mind. It's not so much where's this going to end up, where's that going to end up. So that's the big piece that made it permanent, the qualified business income deduction. A couple other things that it did as well, starting in 2026, is it increased the phase out ranges. So those were 50,000 for single, 100,000 for joint. Those went up to 75 for single and 150 for joint. Essentially, what that is starting at a certain income limit, you start having to factor in things like wages, unadjusted business or business assets, SSTB income, your specified service business income, like your lawyer, help, consulting type income. Some of that stuff starts getting disallowed. What this does is there's a phase-in range above a certain amount. This increases that phase-in range so that more people potentially are able to benefit from a full deduction without having to take some of those limitations in mind. And then the second thing to change in 2026 is they added this minimum deduction of $400. So essentially, if you have at least $1,000 of qualified business income, you're going to get a deduction of at least $400. So even if you don't hit all of the limits or your, things like that from a wage and UBIA perspective, if you don't hit those, you're still going to get a deduction for $400. So that's kind of the big changes on that front.
Qualified small business stock, or QSBS. It's known in the accounting industry as Section 1202 stock. It's not super common. I've only worked on one of them myself. I know a handful of other partners here have only done a couple in the last, 10 years or so. What 1202 stock basically is you have to be a non-corporate taxpayer, so think individual or a trust, and it has to be C Corp stock. That C Corp stock has to be originally issued, and you had to either acquired it by paying for it with cash, or it had to have been included in your compensation. So if Ruben and I, or if I bought Ruben's 1202 stock, it would not transfer to me because I was not originally issued the C Corp stock. But assuming that you meet all those requirements, you were able to sell that stock and exclude either 50%, 75%, or 100% of the gain related to the selling of the stock, assuming you met other qualifications. Depending on when your stock was issued, anytime after 1993, one of the requirements was the business couldn't have a value of greater than $50 million of assets between the time that you sold the 1202 stock and when the company was formed. Another requirement is you had to have held that stock for at least 5 years. It couldn't be in certain industries, like Ruben was just talking about, personal service companies, doctors, accountants, lawyers, etc. None of those industries qualified to be a Section 1202 stock. And also the amount of gain was limited to either the greater of $10 million or 10 times your basis in the stock. So the One Big Beautiful Bill Act came and it changed 3 specific things. First, it changed the holding period of the stock from 5 years at a minimum to like a phase-in window, somewhere between 3 and 5 years. If you hold that QSBS stock for 3 years, you're able to exclude 50% of the gain. If you got up to 4 years, you're able to exclude 75% of the gain. And if you held the stock for the full 5 years, you're back up to that 100% exclusion. The second thing that changed was the amount of the gain excluded cap increased from 10 million to 15 million. However, the 10 times your stock basis is still available if for whatever reason that's higher than the $15 million. And third, the gross assets held by the company or the value of the company increased from 50 million to 75 million. And I mean, it's not a super common thing, but it is out there. And if you happen to effectively be a manufacturer or one of those other industries that are able to be QSBS stock, and you have somebody that wants to acquire your stock, this is definitely something worth exploring. So definitely talk to your advisors to at least rule this out and make sure it's considered. Some other provisions that were affected by the One Big Beautiful Bill is 1099 reporting. So nothing really changes for 1099 miscellaneouses and NECs for tax year 2025. So that a minimum amount of payment to be required to file is still at $600. However, beginning in 2026, that $600 threshold increases to $2,000. This is the first time since 1954, when that $600 filing threshold first came into play, that it's been increased. When Ruben and I were doing this presentation down in Nashville last week, we had an audience member get a kick out of that and looked up what $600 adjusted for inflation since 1954 would be, and it ended up being about $7,000. So we haven't exactly kept up with inflation, but I'll definitely take $2,000 as a filing threshold over the $600 that's been in play literally for the last 70 years. Next up is 1099Ks. Basically, the rules remained fairly unchanged. You needed to have both $20,000 in transactions plus 200 separate transactions to be required to issue a 1099K. And just a little refresher on what 1099Ks are. Those are the forms that you send if you process credit card payments. If you sell stuff on eBay, use Venmo, PayPal. Those are if you sold Taylor Swift tickets, you probably got a 1099K in the last couple of years. But again, it was $20,000 and 200 transactions. The American Rescue Plan signed back in 2021 tried to align 1099K reporting with other 1099 reporting, bringing that threshold down to $600, which created a administrative nightmare for both the IRS and the companies issuing 1099Ks. And with so many people raising a fuss about it, the IRS basically delayed implementation of that reduced threshold and kind of did it as a phase-in type of thing. So beginning in 2024, that threshold came down to $5,000. For 2025, it was supposed to be reduced again to $2,500. And then in 2026, it was going to go down to the $600. The OB3 came in and kind of saved the day with this one and restored the original filing thresholds of $20,000 and 200 separate transactions to be required to issue a 1099K. ERC penalties. These are more like a ceremonial inclusion in the OB3. They don't have a whole lot of teeth to them, but basically it does a few things. The first, it creates a new 20% erroneous refund penalty. There's been a 20% erroneous refund penalty available for income tax refunds. So this now includes employer tax refunds or non-income tax refunds to be subject to this new penalty. However, for ERC specific things, it only applies to refunds that were issued after July 4th, 2025, which isn't many, as the ERC, you haven't been able to file an ERC since at the very latest, April 15th of 2025. So not many refunds are being issued now, but this would come into play more if anything like the ERC ever happened again in the future. We also extended the statute of limitations specific for Q3 and Q4 2021 ERC claims. It increased the standard statute of limitations from 3 all the way to 6. So that effectively means if you filed your Q3 or Q4 2021 ERC claims late, you basically are open to an audit all the way through 2030, which is wild to say out loud. And then 3, it creates a new definition in the Internal Revenue Code called ERTC promoters. Basically, they took all of those boutique firms that were saying, you qualify for all of this credit money. We'll do all the work. All you got to do is pay us 30% of your whatever refund you get. The IRS didn't like that and made a new definition. It's basically anyone that provided aid, assistance, or advice with respect to the ERTC. And they also charged a fee based on the amount of the refund. And the ERTC claim revenue constituted a significantly high percentage of the promoter's annual gross receipts. If they meet all 3 of those criteria, and they found that they were representing a lot of clients in false and fraudulent claims, they're now subject to a penalty of $1,000 per occurrence. But again, this is only applicable for things that happened after July 4th, 2025, which is not many. The OB3 also invalidates late filed 2021 claims. Anything that was filed after January 31st, 2024 basically got thrown in the trash and will not be processed by the IRS. Couple different things after the ERC that changed with OB3. TCJA created a new section under 461 that limits business loss deductibility on your individual return, basically so you're not offsetting a ton of non-business income with a business loss. This was slated to expire at the end of 2025, well, like most TCJA provisions, but now it's a permanent thing we got to deal with going forward as part of the OB3. And then meals and entertainment changed a little bit. Just as a summary overview of the availability to deduct meals, it basically falls into 3 categories. Something can either be 100% deductible, it can be 50% deductible, or it can be 0% deductible. For something to be 100% deductible, it's usually got to be like an employer-sponsored recreational or social event, like a Christmas party or a summer picnic, something that benefits all of the employees and not just the highly compensated one. Those are still 100% deductible by the company. For something to be 50%, it's basically all other meals. The meals has to be ordinary and necessary. There must be a clear connection between the meal and the business event. The expense can't be lavish or extravagant given the circumstances, and a taxpayer or a representative must be present at that meal for it to be 50% deductible. 0% deductible items are your entertainment expenses and meals that are not separately stated from the entertainment expense. And then here's where things get changed with the OB3. So back in 2017 with the TCJA, there was a new code section under 274 that was added that basically eliminated the deductibility of meals provided for the benefit of the employer. So think of these as like cafeterias inside of an office. All of those meals were set to be non-deductible beginning in 2026, and there were no exceptions listed under 274.0. Well, OB3 comes in, and there's 2 new caveats. One is for restaurants to provide meals to their staff, which is fine. Those still are able to be deducted, but specifically if you have certain fishing operations or offshore fish processing facilities, which I believe only occur in 2 states. One is Alaska, one is Hawaii. And Alaska had a senator that was a key vote in passing of the bill. So this is what we like to call their carve out to make sure this got across the finish line. those meals provided to those offshore fishing processing operations are still able to be deductible. But those are the only two exceptions to 274.0 that exist. All right. So now
All right, so now we're going to start hitting on a couple of the individual tax law changes that came about from the OB3 and kind of are going to be effective for 2025 and 2026 going forward. So the first couple that we wanted to hit on are probably ones that you've seen pretty heavily in the media since the passing and probably even since the election, right? Of things that we're getting promised. So this first one here is the tip exclusion. So starting in tax years 2025 through 2028, people that receive tips are going to be eligible to exclude up to $25,000 of their tips from their taxable income. That does start phasing out at AGI above 150 for single filers and above 300,000 for married filing joint filers. A couple of key things to keep in mind with this, though, is first, they have to be tips received in occupations that customarily receive tips. So Treasury has since come out with a full kind of comprehensive list of occupations that they believe customarily receive tips. If you do not fall under one of those occupations, then you cannot exclude your tip income from taxable income, right? So I can't be a sole proprietor CPA, start adding a tip line to my invoice and start excluding that taxable income or that income from my taxable income. I wouldn't be considered on that list. Second big point to keep in mind is that these tips must be voluntary for the payor, right? So think about maybe a fancy restaurant or a country club or something like that, that automatically adds a 20% gratuity to their bills, right? That the IRS does not consider that a tip. The IRS considers that a kind of service fee. So the waitresses, waiters, things like that, getting those tips would not be able to exclude those from their taxable income as well. These theoretically would be reported on your W-2 or Form 1099. I'll touch on that a little bit more here in a second. I think going forward, 2026, there's supposed to be a kind of a special code on your box 12 that's going to report your W-2 on your W-2. That's going to report your tip income on 1099 as well. We'll have some requirements there. 2025 is going to be a little bit of a free for all. Like I said, I'll touch on that here in a second as well. The second big exclusion is the overtime exclusion, right? So again, very similar time frame to your tip income. Tax years 2025 through 2028. Taxpayers are eligible to exclude up to $12,500 of their overtime pay if they are single filers, starting to phase out at $150,000 of AGI, and then up to $25,000 for joint filers, again, starting to phase out at an AGI of $300,000. A few big points to kind of keep in mind on the overtime piece. So this is overtime as defined by the Fair Labor Standards Act, and that's relevant for a couple of different reasons. The FLSA, the Fair Labor Standards Act, essentially defines overtime as the premium portion of overtime pay that exceeds the regular rate, right? So if you think of overtime as time and a half, the overtime pay according to FLSA would be the and a half portion. That's pretty important, and we kind of got into a discussion down at our Nashville presentation as well, where I think employees, right, might be thinking of, oh, I make $20 an hour right now. Overtime is $30. That $30 an hour is what I'm getting excluded from taxable income. That is not the case, right? It's just the additional $10 of income that you're getting paid. So that's important point number one related to that FLSA standard. The other piece related to that is that FLSA typically defines overtime as anything above 40 hours per week. And what you'll find is that states have different definitions of what overtime is. Maybe different companies might have definitions of what overtime is, right? I think California, for instance, has overtime is anything above 8 hours in a day. All that to say is those definitions and those standards don't matter for this purpose, right? It is strictly the overtime above 40 hours per week that is relevant for this purpose. These pay will still be subject to Social Security and Medicare tax. And then again, we reported on W-2 or Form 1099. So that key point there, right, the no specific W-2 reporting for 2025 is really key as what I wanted to touch on in terms of what's kind of going to make 2025 a little bit of a nightmare scenario for employees and I think tax preparers, right, like us. So the IRS came out a couple weeks ago, Notice 2025-62, which essentially calls 2025 a transition year and gives penalty relief to employers for the reporting of overtime and tip pay. So what that means is that there's no real standard for employers to report their tip and overtime pay to their employees for 2025. It essentially says, hey, it would be nice for you to do this. Maybe provide your employees with a schedule, maybe put it in box 14 on the W-2, something like that. But they're not required to do that. So employees are essentially going to have to figure this out on themselves, which again, with some of the different nuances, I think is going to be really difficult for them to kind of go back and figure out, especially when you think of overtime pay, right? In terms of what's on your pay stub, what's on your what's on your annual statement. How can you even go back to figure out what's the and a half portion of my overtime? That type of stuff is going to be a little bit of a nightmare. And then from a tax preparer perspective, we're really going to have to rely on what our clients say that they got for tip and overtime pay to kind of use that, right? It's probably going to be a question in the organizer. We're going to say, did you receive it? How much did you receive? And we're kind of going to have to rely on that for this year. I think 2026 and going forward, theoretically, it should be a little easier. There's going to be some reporting requirements and things like that. I think it'll still need to be the payroll companies figuring that out. But for 2025, it's definitely going to be a little bit of an issue for us to figure out.
All right, so we're going to transition down to other deductions. So the standard deduction table already had been released by the IRS earlier this year. The OB3 basically just raised the amounts slightly. They're going to continue to be subject to inflation every year, and these increased standard deduction amounts are now made permanent. If we remember pre-TCJA, basically all these numbers were cut in half. The TCJA eliminated the thing called personal exemption allowances. Those are now permanently removed from the code as well. And we get these new higher amounts subject to inflation every year, and they're here to stay. Also for 2025, 6, 7, and 8, individuals 65 and older can claim an additional deduction of $6,000 per person, subject to some phase outs. This was the campaign promise of no tax on Social Security. It's not quite that, but it is something, and it's only available for these 4 years. The phase outs are listed here on the screen, and they're fairly low. So if your AGI is greater than $75,000 as a single taxpayer, that $6,000 starts to phase out, and it doubles for joint filers at $150,000. Anything over that, it starts to phase out as well. And again, this is only for tax years 25, 6, 7, and 8. State and local tax deductions. This was a hotly debated item as the TCJA was set to expire and what would have been included in any legislation. Beginning in 2025, the SALT cap increases from $10,000 to $40,000. Half of which would be applicable if you were married filing separate, $5,000 to $20,000. And then beginning in 2026, that $40,000 cap is raised by 1% annually through 2029. And then beginning in 2030, that increased limitation goes all the way back down to $10,000. That increased SALT cap also has a phase out for taxpayers with income over $500,000. So a lot of our high income taxpayers is in that $40,000 cap really isn't going to come into play a whole lot, as it's reduced by 30% of the amount that you're over $500,000. However, there still is the floor of $10,000, even if by following that limitation, you'd have less than $10,000 available, you're guaranteed at least $10,000 for a SALT deduction. Earlier drafts, as we remember, we've talked the last several years about pass-through entity tax elections for our flow-through entities, your partnerships, your S corporations, where you can make an election and pay the tax on that flow-through income at the business level and deduct it at the federal level. as a workaround for that $10,000 SALT cap. That stays in place, and we definitely recommend taking a look at that at the business level to see if you're eligible to make that election. The OB3 did not eliminate the ability to do that. Mortgage interest. Again, pre-TCJA, you were able to deduct interest on mortgages with a cap of $1 million. TCJA came in and reduced that $1 million cap down to $750,000 cap. That was slated to expire and go back to the $1 million cap at the end of 2025. The OB3 came in and made that $750,000 limit permanent. Also, beginning next year in 2026, you're able to deduct mortgage insurance premiums again. Those fell off, I believe, at the end of 2021. For qualified passenger vehicle loan interest expense, this was the deducting of the vehicle interest that was touted during the campaign time and when the legislation was pending. The OB3 came in and said you're able to deduct up to $10,000 in car loan interest on your federal return for vehicles purchased between 2025 and 2028. This is an above the line deduction, which means you can claim it even if you don't itemize. There's certain thresholds and qualifications, such as it has to be a personal vehicle. It has to be a personal vehicle under 14,000 pounds. So think of cars, trucks, some SUVs, motorcycles, the like. It can't be business related. It has to be your personal passenger automobile. It has to have its final assembly take place in the United States, and it has to have been purchased after December 31st, 2024. The cap is $10,000 a year, but it is also subject to certain phase outs. If you're a single individual, and your income's over $100,000, you start to become subject to a limitation. Same as if you're a $200,000 income joint taxpayer, that $10,000 cap starts to get phased out. Charitable deductions changed quite a bit with the OB3. First, for non-itemizers, beginning in 2026, you're able to take a deduction of either $1,000 for an individual and $2,000 for a joint taxpayer. It has to be a cash, check, or a credit card donation to a qualified charity, and you can't give a donation to your donor advised fund and still get the deduction. So that's kind of cool for us non-itemizers out there. Now for the itemizers, this is where it gets kind of wild. Beginning in 2026, there is now an AGI floor of 0.5% of your income, meaning if your income is $500,000, the first 0.5% or $2,500 of your charitable donations are no longer deductible. It also reduces the benefit for high income earners that are in that maximum tax bracket of 37%. You're only able to deduct 35% of those charitable donations. So you're losing not only the 0.5% floor, but you're also limiting the deductibility at 2%, the difference between the 37% and the 35% tax rate. Why they thought limiting charitable donations was a good idea, I do not know, but these are the laws that are in place, and we gotta plan around them the best we can. In general, new itemized limits beginning in 2026, just in general, in addition to that charitable tax bracket limitation, your total itemized deductions are capped at 35 at the tax rate of 35%, even if your federal tax bracket is 37%. So this only affects your high income tax bracket people, but it is a new limit and it's a permanent limit.
All right, so a few important changes from a dependent standpoint that also came through in 2025. So the child tax credit was increased to $2,200. That'll be adjusted for inflation going forward. that was set at $2,000, and up to $1,700 of that is refundable. That does start phasing out at 400 AGI for minor filing joint and 200 AGI for single filers. You do also get a $500 kind of permanent credit for any qualified dependents. So even if they're not qualified child, you still get some benefit there. From a dependent care perspective, they increased the FSA, so your dependent care FSA that you can contribute to. That was $5,000. That's gone up to $7,500 for your married filing joint taxpayers. Also related to dependent care, they made some beneficial changes to the dependent care credit. So that is up to 50% now. It was up to 35%. They also increased some of the phase out ranges for that as well. So potential to get some more benefit from the credit, even at some higher income levels. The adoption credit, the big change there is they made that refundable up to $5,000. Previously, there was not a portion of that refundable. It can only reduce your tax. It couldn't get any benefit beyond that. So I think that'll help incentivize and give some benefit to the adoption families out there as well. And then lastly, they added these Trump accounts. And so what these are, and essentially for any U.S. citizens born between December 31st, 2024 and January 1, 2029, the government will add $1,000 to these accounts for your eligible child. And then you as a parent, grandparent, whatever, can contribute up to $5,000 per year thereafter. Those amounts have to get invested in mutual funds, ETFs that are similar to the S&P 500. And then once they turn 18, they essentially convert to a traditional IRA, which means that they are tax deferred accounts and not tax-free accounts like a Roth or something like that. So that's one thing you probably heard about quite a bit as well here over the last year. A few other things from just other deduction standpoint, casualty losses. All of these casualty losses are still essentially the same, generally disallowed, except if you're in a disaster area. The big change here is they added in that you can be in a state declared disaster area. Prior, that was only federally declared disaster areas. So potentially increases people that can get some benefit there. Wagering losses. This is a big one that came out afterwards, where you see a lot of members of Congress that were essentially saying they didn't know this was in the bill. But for your professional gamblers, this has been a big one. We're starting in 2026. Your wagering losses will be limited to 90% of those losses. Right now, you can take 100% of your losses up to your gambling winnings. Again, starting in 2026, even if you have $100,000 of winnings and $100,000 of losses, you can only take $90,000 of those losses. So you're still gonna have to pay $10,000 of tax on your gambling winnings, even if you have the losses to offset them. From a Section 529 standpoint, the big thing there is they expanded the eligible costs. So you can use those for things like books, instructional materials, certain non-degree credentials, things like that, which is beneficial. They also increased the amount that you can withdraw for your K through 12 education. So that was $10,000. They jumped that up to $20,000. So some benefit there. A few things that were fully eliminated. So your personal exemptions, these we haven't been able to take advantage of since TCJA. Those have now been permanently eliminated. We haven't been able to benefit from those over the last several years as well. That's why our standard deduction has increased so much. Our moving expenses, again, permanently eliminated except for your active duty military members. These were another miscellaneous itemized deductions that we weren't able to take advantage of over the last several years either way. Many of the clean energy credits that came about from our Inflation Reduction Act from a year ago or so, many of those are getting eliminated and as well. And then lastly, just your general 2% miscellaneous expenses. Those were things like your tax prep fees, investor advisor fees, things like that. Again, fees that we weren't able to take advantage of for itemizers over the last several years either way, those have just now been permanently eliminated. With the one caveat being your unreimbursed educator expenses. Those have been added to itemized deductions for 2026 going forward. Previously, those were above the line and limited to up to $300. So I think that's beneficial for educators. They're able to potentially deduct more expenses. They just have to be able to itemize to take advantage of that expense. From an AMT standpoint, just a couple quick slides here left. From an AMT standpoint, I think the big takeaway I wanted from this slide is that there were changes from the OB3 that could potentially have more people be subject to AMT. So it's just something that, again, that as we get into tax planning, as we get into year end, we just want to make sure we're taking these things into account so that we're not surprised April 15th or whatever, right? We just go to file your tax return in 2026 and end up getting hit with AMT when we could have kind of done some things going, initially to help us there. And then lastly, from the state and gift tax standpoint, this was another big thing that we were talking about that was set to sunset in 2025, where our exemptions were going to be essentially cut in half. OB3 did not do that, right? They kept them at the same for 2025, and then they're going to increase for inflation going forward. So that's 14 million in 2025, a lifetime exemption, up to 15 million in 2026. We do still have portability there, which is really good as well. And then our annual gifting, again, 19,000 for 2025 and going to be adjusted for inflation in 2026 and going forward.
Okay, as we start to wrap up, we got a couple tax planning ideas that we came up with as we were creating these seminars and presentations. The first is utilizing Roth conversions. Ruben and I both talked about a couple of areas where there's a possibility your 2025 taxable income is a lot lower than it typically is. R&D, disallowed expenses being freed up. Same with the 163J business interest expense. Those disallowed expenses being freed up. If for whatever reason your income is way lower than it typically is, now would be a great time to utilize a Roth conversion to take advantage of those lower tax rates, convert some of that pre-tax money to post-tax money, and take advantage of tax-free growth. Itemized deductions specifically for charitable donations. As we remember, those high income taxpayers over $500,000, or basically anybody in the 37% tax bracket, is only going to benefit for 35% of their charitable donations. So that all takes effect in 2026. So we have a month and a half to take full advantage of increased charitable donations. If you so choose to, this will be the last year in the foreseeable future that you would get the full 37%, 37 cents on every dollar donation deduction. Consider making the PTE election at the S corp or business level. That's the $40,000 or the $10,000 state and local tax cap workaround. And then revisit your trusts now that the state and gifting limitations are permanently increased. Revisit your trust documents, make sure everything's still in line. Because like Ruben said, at the end of 25, those were slated to basically be cut in half, and now that's not the case. All right, we're gonna do our third and final CPE polling question. Lindsay, can you please pull that up for us?
Absolutely, launching it now. I know we're just a minute or two over, so I appreciate everyone staying on with us. I am going to end the recording after this. If anyone would like to stay on for some Q&A, you are more than welcome to. And thank you to Chad and Ruben for the presentation today. I will leave this poll open for just a few more minutes, not minutes, sorry, seconds, so y'all can get your answers. Okay, ending it now.
All right. As we wrap up here, the one big beautiful